Hey everyone, welcome to our YouTube Live for the Real Estate Ride Along Show. So my name is Chris Lopez. I'm in the burgundy Virginia Tech t-shirt. Terrance Doyle is in the all black over there. So we're going to be talking a lot of multifamily stuff today, answering some questions and answers. So for those who don't know us, we are the host of the Real Estate Ride Along Show on the Bigger Pocket Show, where twice a month we go walk properties out there. We always bring along a guest. We walk a property, we come back and do a deal analysis, plug into the BP calculators. And so it's really trying to bring along anywhere from like a new person to a very experienced person come with us, ask us questions, and just give a completely different point of view on real estate. Because we've always had the best conversations, Terrance, with people just like being a part of our day-to-day actions, putting deals together, walking properties, and the show is trying to replicate that.
Yeah, absolutely. Just people that are looking to grow their real estate portfolios, and they have genuine questions, and that's the kind of stuff we enjoy helping out with. So a little Thanksgiving edition of the Q&A, see who's working on real estate out there and see how we can add some value and continue to sharpen our skills as well.
Yeah, so start putting in your multifamily questions here. We will start answering those as they come in.
We've had some questions from the past that we haven't been able to get to. We could going over a few of those.
All right, bring them up. You kind of memorize?
Well, I have a few on social media here. Let me pull them up.
Yeah, so we're going to pull up some questions here. So if you guys have questions on previous shows, I'll pull up some of those, Terrance. You got some social media ones. We'll go on there. All right, Connor, you got the first question, man. So we will go with there. And we do have a hard stop at about 2:30 today. I had a last-minute thing come, so I have to head out earlier than usual. But at 3 p.m. today, we have our next ride-along show dropping out. It is where me, Terrance, and two guests go walk. I think it was a condo. It's actually a condo I bought earlier this year. So not the multifamily one, but that's what we were able to record and talk numbers on there. So let's start with Connor. If I can hit it right. So Connor says, when does implementing cost segregation make sense and from the start? So cost segregation first, let's define what that is, because one of the great advantages of real estate is the amazing tax advantages
depreciation.
We get. Yeah, depreciation.
Right.
But when you buy a building, you typically get that 27.5-year depreciation if it's residential, and it's like 39 for commercial. I don't know.
It's 27 and a half.
For residential, commercial's higher, I think. I only know residential. That's what I do. But basically, if let's say for simplicity, you buy a building for $1 million, and the land is worth $200,000, and the building's worth $800,000, then you get to take $800,000, divide it by 27.5 years, and then you get that write-off every year.
So roughly $35,000 a year you get to offset.
Yep.
So even if you collected $40,000, you get to offset the $40,000 you collected with the $35,000 that you're depreciating. And basically, cost segregation is just a bonus depreciation where when you make substantial improvements. So let's say you do new windows, new flooring, new carpet, new cabinets, countertops, bathroom tile. They basically take each one of those items and depreciate that over the life of that item. So you're basically getting the same thing as what Chris talked about over 27 and a half years of the building, but you get to add on the depreciation of every single improvement.
You get to front load it.
Yeah, exactly.
Yeah.
And 100%. And so what you end up seeing is when you buy a building, let's say for $1 million, you put $500,000 into it, you get to depreciate, let's say $300,000 or $400,000 or $500,000 that first year, whatever the improvements end up adding up to.
Yeah. And I learned this because I talked to there's some really cool cost segregation softwares now.
That's
it used to be like, it'd be like $20,000
you have them on
easy.
the podcast. It was really good.
Yeah. You can do software for like $1,000
Right.
too. And it doesn't have to be all new stuff. They can take an existing building with no updates and figure out the carpet, the paint, the trees in the front yard. And I mean, this will be rough numbers, but we ran an house like $1 million building, and the tax benefits have been like $35,000 a year. To do a cost segregation, it would have front loaded like $140,000.
Yeah.
So just huge.
Juices the depreciation a lot. Yeah.
Which can be great depending on how you're structured and all that. So when does it make sense? I don't have a good rule for that.
As soon as the construction is completed, and it also depends on your personal tax situation. If you had some big wins that year, then you want to do it earlier than later. But if you didn't, and you're not going to have a big tax liability, then you can wait and do the cost seg down the road. But it really depends on you and your partner's personal tax situation. A couple years, we had some big wins, some shorter term flips, or we were selling some things that had some big tax liabilities. So we did the cost seg that year to offset the gains.
So you cost seg some of your properties?
Oh, multiple properties. Yeah, huge. Yeah, I still have a negative carry forward from cost segs that I did 2 years ago.
What's the negative carry forward?
Basically, let's say that I sold a property this year and made $500,000. A negative carry forward means that it's going to offset that gain from this year. So if I did a cost seg 2 years ago, and let's say it was, it offset my gain and I had a negative $1 million tax liability, the government's not going to write me $1 million. They're just going to use that million to deduct from any positive gains I have the next year.
Because it's a paper loss. It's a tax return loss.
That's exactly right.
Yeah.
And the cost seg is a great tool to offset gains from that year, or to wait for it until you have a year with some big gains.
You know what? We should do a full episode on that one day, because that's a good topic.
Like, we could do a full episode.
And bring some experts.
No, it's an incredible tool. We've used it several times. There's obviously a bunch of other data out there. We're not engineers. We don't specialize in cost seg, but I would just say you want to do that when you know you're going to have a big tax liability for that year. That's the right time to do it. And after you've made improvements to the property.
And for a disclaimer, always talk to your CPA and always talk to your cost segregation company, because we're not licensed professionals. So make sure you talk to them. So I know about it. Terrance has used it.
Yeah.
And you have to really just run the numbers and also understand, hey, when you sell it, what's the pros and cons? If you 1031, what's the pros and cons?
It is expensive. I think we did 3 of them one year, and the buildings were all over 50 units. And I believe it ended up costing us north of $10,000. So you want to make sure that the gain and the deduction you're going to get is, much more than what it's going to cost you to do.
Yes. So great question, Connor.
Yeah, Connor, that's right on, man. Good stuff.
Genesis asked, will this be recorded to watch later? Yes. So this is the YouTube live. So it will just automatically
go back and watch it anytime.
Be on YouTube and should be in the Ride Along Show playlist.
Yeah.
All right. What do you want to pick up here next, Terrance?
What do we got? A lot of questions here rolling in.
Let's see. All right, so I'm gonna put Eric here with the VA loan, since Veterans Day was 2 weeks ago. Veterans still get the first come, first serve treatment here. So Eric, thank you for service. If you're using VA loan, that means you're a veteran. So thanks. He said there is a hold on VA loan renovations. If I use a VA in a property, what would be a good loan for a renovation? So VA loans have to be for owner-occupied properties. So we're probably talking a house hack here. So we're buying a house hack with a VA loan for 0% or close to 0% down.
That's right.
But then you need to renovate it. So depending on the extent of the renovations, that gets very tricky.
Right.
And I don't know all the nuances of VA loans. I know there's all different things. It's always your lenders, your best bet to go out there and see what is currently on the market. But for, if we're talking, hey, we're talking 20,000 renovation, or we're talking 100,000 renovation. So Terrance, you do rehabs and construction loans and private money all the time. What is your thought process here for funding the rehab and funding the construction?
If there's architects and GCs involved, you're going to want to go to a local bank. I think that's the best rate you're going to get, and they're going to it's going to make the most sense financially for you to go to a local bank. Now, if you don't have enough equity in the property and they don't approve the construction, you're going to have to go to friends and family or a private money lender that'll give you the money for the renovation, and they're going to probably charge you anywhere from like 8 to 10%. If that doesn't work, I think the last option would be going to a hard money lender that then is going to put a second position on the property, and they'll give you the money. It'll probably be closer to 10 to 14% with some points. But it's going to really depend on the size of the size of the renovation, so the scope, and how much equity you have in the property. So if you just purchased it and you have 100% financed, it may be really tough to do. You may have to go to friends and family, have them loan you the money, and then you can refinance it once the improvements are made.
Yeah.
But it's really going to depend on what the scope is and how long you've owned it, how much equity you have.
But if you can do anything through the VA loan program, do that first, because you're going to get the best terms,
the best treatment, right?
Way better than hard money, private,
or a local bank.
Probably better than family as well.
Yeah.
Because VA loans are just great. Ooh, all right. So Frank says, "Hey guys, I live in Lakewood, Colorado. We're probably about 5 miles away from you here in the DTC area, and he's also VA. So Frank says, I just secured my 10th door, which is a fourplex VA owner-occupant house hack. Congrats, Frank. I have a big goal to jump into multifamily in 2021 and learning a ton from you all. Any quick tips from transition to multifamily? Multifamily, I'm assuming we're dividing 5+. I mean, that's, I kind of, multifamily is really like 5+. So I don't know if you guys know Terrance's background. He is one of the best guys in the country to ask, because Terrance started a fix and flip business years ago, lots of single family homes, started doing a couple duplexes, fourplexes, and about 2.5 years ago, you transitioned to multifamilies. I think your first property was a 23 unit. Now you're doing 100+ unit buildings. You have scaled.
Yeah,
and
2017. Yeah. No, we've made a ton of mistakes, and that's why we're here, so we can share those and keep you guys from making the same ones. I've thought the same thing, Frank. I wanted, we had done a bunch of duplexes and fourplexes and houses and was looking to grow and add a zero to what we were doing. So it sounds like in a similar situation as you. My advice, we've recorded a couple of podcasts on the transition that you could go and listen to. But I think to summarize, the advice would be, you have to get your finances in order and understand what you can qualify for. So the first step would be, you have to have a proof of funds or an investor or a pre-approval letter from a lender. So a couple of the good ones in Colorado, Bank of Colorado, AMG Bank, First Bank has gotten pretty aggressive on multifamily. You're really going to...
First Bank has?
Yeah, on multifamily. Okay. Yeah, First Bank has. Yeah, they actually have a lot of deposits right now because people have taken money out of the stock market before, during the pandemic. So they had a lot of deposits and they were offering some pretty incredible incentives for multifamily. Very specific on location. So obviously, the better the neighborhood, the more aggressive they're going to get on terms. They were not as aggressive in neighborhoods like Aurora. So I would first talk to a lender, understand, or if you're going to have partners, understand what the capital stack is going to look like, and then I would. Sourcing fourplexes and duplexes is totally different than sourcing a 20 unit, and it's going to come from a different broker. So I would start reaching out to brokers after you have your proof of funds or a pre-approval letter, and after you know what you're looking for. You're going to want to meet with different brokers, and I think the key is really understanding what your buy box is. You're going to have a lot more success, like way faster and much better results if you are very clear on what you're looking for. So I'm looking for a 10 unit, I'm looking for a current 5% yield, or I'm looking for a 6% yield, or I'm looking for a value add where I can add 20% to rents over a year. You have to know exactly what you're looking for, and then you can start to meet with local commercial brokers. I would not meet with anybody until you know exactly what you're looking for, what your goals are, and have some kind of approval letter. That's a tongue twister. Once you have your finances in order, and you know exactly what you're looking for, the more clear you are on what the target is, the better chance you're going to have of success when you meet with brokers.
Yes. And so, I'm a broker here in Denver, and the last 1.5 years, we've been getting more into like the small multi, like 20 units and less. And so I have a lot of conversations with people, and we work with a lot of like new investors and just return investors. Well, but I can tell you, like, at least a few times a month, people, hey, I want to get into like, the multifamily, the 5+. I'm like, cool. Oh, what's your proof of funds? Oh, I don't have a lender yet, but if you see a good deal, tell me. But they don't have a proof of funds. And I try to figure out what they want to buy. Well, like a good deal. I'm like, no, dude, I don't know what a good deal is. Like, give me numbers, give me this. And the people that articulate it, you don't have to have this on the first call. I mean, ideally, if you do, you're going to most likely get your notes saved in this contact management system. But you say, cool, I'll figure out and get back to you and do it. But if you don't know what you want and you can't clearly articulate it, like Terrance can articulate it, and he knows pretty much every broker in Denver, and that's why he closes a bunch of deals. If you can't articulate it, you're not ready to go, it's a waste of time. And brokers, like I have people, I'm not even bothering to put their notes in the system. I just delete it.
Yeah, 100%.
I'm like, dude, you're not serious.
Yeah, I think the interesting thing, Frank, is just understanding who the brokers are that you're talking to. They're 100% commission. They maybe close 5 deals a year, and those deals are normally really large commission checks. So they're not going to waste their time finding or sending you off-market deals, because let's be honest, the best deals in commercial are all off-market. Once it hits the market, it's overpriced, and it's normally going to go to an institutional buyer or someone in a 1031 that really has to buy it and pay a premium for it. So you're talking about there's very, very little inventory, very hard to come across. And so you have to be very clear and have all of your stuff together in order to get a chance that they're going to call you and remember you when they have a deal. And the key is they're going to make you more of a priority the more organized and the more ready you are to buy. because they know that that's going to equal a commission check for them.
Yeah. And I mean, I just want someone to like, I mean, we get deals like, hey, cool, let's be good for like, hey, this guy can make a decision. He can move. He's going to get first look usually.
That's right. Yeah.
I mean, that's why you get deals sent to you. I mean, that's
right.
Again, we were just talking earlier before this. Like, if you make someone's life easier, you're gonna get stuff.
You're gonna win.
Put your way out.
Yeah. That's a great question, and I love the transition. I'd love to hear a success story in the next couple of months of how you're able to apply that and get a deal done.
And stay in touch, Frank, since you're a local man. We got some big ideas, a lot more content here. So stay in touch somehow. Find some bigger pockets. All right, so Sam Brown hacked the system. He said, "Go Hokies."
Yeah.
Virginia Tech is the Hokies.
Not a multifamily there, but that's a good shout out.
No, he does.
Oh,
so this is actually one of my favorite questions. He says, if you were starting over, what would you start with? Buy, hold, flip, commercial, retail, storage unit, short-term rentals, etc. What would you do? I love this question.
Phenomenal question, Sam. And I see what you did there with the Go Hokies. He got your attention, and then you went to his question. I got it.
I like it. That's
crafty.
He cracked it.
Crafty Hokie. So what I would do if I had to start over, and if I had to start over with zero capital in my bank, just knowing what I know now, I would have to start with the fix and flip. And the reason is you can get into those for virtually zero of your own dollars in. And it's a pretty low price point. And because of my experience and understanding construction and the Denver market, I just think that's, if I was trying to accumulate equity to then go buy a multifamily and I had to start over tomorrow, I would try and look for a flip, and I would look for like a lower end flip, $300,000 or $400,000. I'd go get 100% or 95% of it financed by a hard money lender, make 20,000, do it again, do it. You know, I probably had to do it 100 times before I had enough money to really get into multifamily deep. But maybe you do it 5-10 times. You got $100,000, $200,000 that I'm going to go buy a fourplex, and I'm just going to build my way back up to, up the ring of having significant cash flow and equity in multifamily, which I think is obviously my favorite asset.
So I'm going to peel back that answer a little bit, because I think the best thing is depends on your strength.
Mm-hmm.
And this is what I went through, like 4 or 5 years, right? When, we met soon after I got into real estate, Terrance, connected on bigger pockets. I came to the fix and flip because that's what everyone says to do. Yeah. I made 24 grand. Did not like fix and flips. Realized, that's not for me. I could do, but I'm going to have to spend years.
You didn't like the construction, or what was it?
Just, I realized the whole process, it didn't play to my strength. And that's my thing. My things, what I look for now, does it play to my interest and does it play to my skill set?
Right.
And fix and flips not play to either of those. It's just my interest was not there. My skill sets are not construction and doing that stuff. My skill sets are I'm good at marketing and I'm good at financial modeling. And so through an evolution, I realized, hey, focusing on rental properties and being an agent was the best route for me because agent commissions are good. If you can crank deals, you can make good money.
Right.
Take that money and go out there and invest. So I would say the biggest thing, don't look at asset classes first, but look at what is your strengths that you can bring to the market. And I looked at my strengths, which was marketing. I looked at my strengths, which was financial analysis, and realized, hey, a lot of realtors and real estate does not know this. And then go out there and create some type of partnership or mentorship opportunity and leverage that. And then real estate, I'm agnostic towards what's a property, but I want to do something that interests me and plays to my strengths.
I think that's a very thorough answer, and I really like where you're going with that. And I think my answer plays into my strengths, is I know how to source deals, I know how to get construction done, I know how to aggregate capital, even if it's not my own. So 100%, I think the key, Sam, is knowing your strengths and then being able to play to those inside of the real estate game. Obviously, Chris and I have different strengths. So mine would be starting over, trying to do a project. And I think, Chris, what you're saying is you would start over and do a lot of marketing and find ways to create revenue from your marketing, which is what you've done in Denver since you got here. And
the last thing I'll say, one of my attitudes is I will fail faster than probably all you guys on YouTube. I think you're the same way, Terrance, is like, I don't really care about the failures. Like, we know our downs. Hey, cool, we fail. Cool. This is the hit we take. And we
closer
can survive.
To an answer, right? I'm closer to the winner.
Yeah, but the faster I fail, and this was my philosophy in dating. Hey, I'll take the no's to get the yes to get the girl's phone number. Same thing in business and real estate. I'll go through the no's and get the failures because it's one step closer to being a yes or a success. Yeah. We will both fail a lot.
Oh, yeah, a lot.
But we'll do it quick. We'll get off and we'll move on.
And we'll get to the right answer. That's right. Yeah.
But we don't hold on to that. Cool, we failed. Okay, let's do a postmortem. Here's what I did wrong. Here's what I learned. All right, what's next?
Dust it off and move on. That's right.
All right. What do you see here, Terrance? I got so into that question.
Someone was talking about syndication down there. We could talk about that. Or Dre 38. Can you tell us how it down there? Right there. Dre 38. Can you tell us how hard money lenders work? Term, length, amount, credit, etc.
Me or you?
You want to take the first shot at it since I asked the question?
Sure. All right. How do hard money lenders work? Well, every hard money lender is going to be different. That's the thing to understand. You go talk to 5 hard money lenders, they're going to have different underwriting, different terms, different everything. But they're still going to check out you and the property. But they're all are going to charge points, which is what you pay up front. So if I go out there and need a $500,000 loan, they are going to charge anywhere from like 1 to 3 points. And 1 point is 1% of the loan value. So if I get a $500,000 loan, 1 point is
$5,000.
$5,000.
Yeah.
If 2 points is $10,000. And then I look at the interest rate, which is usually between 8 to 12 right now. I think until you have a relationship and track record. 8 to 12 that we're seeing here in Denver. I think that's pretty common nationwide. So 8 to 12%, and most terms are 6 to 12 months. And then a lot of times they'll give you draws on the money you need to go out there. Hey, cool, you buy the property for $300,000. I need $200,000 for renovation costs. Cool, here's the money to buy the property. Then once you go out there, we'll give you a 5-draw system. Once you go out there and we'll walk the property, show us receipts, and you get your first draw of $50,000 to go out there and fund things. How'd I do, Terrance?
That was really good. For not having, have you ever taken a hard money loan?
One for my one fix and flip.
Yeah, I've probably taken.
I think you've taken a little more than
500 hard money loans. That's really good. I think the key, Dre, is your first time, like anything else, you either want to partner with someone that has a really good relationship and is experienced. Maybe make them a partner in your deal, because what you're going to find is that lenders, from hard money lenders to private lenders to banks, they're going to be much more flexible and gracious on terms the more experienced and the better they trust you. So if it's your first time and you don't have a lot of cash in the bank, you don't have a big track record, you're going to pay a premium, and they're going to be very low loan to value. So if the property's 500, maybe they're going to lend you 70, 75%, especially right now where there's a lot of uncertainty in the market. But if you're next to someone like myself that has a long track record, they may give you 100% of the purchase price, and they may even take off the points and lower the interest rate just because they want to lend to people that are experienced, because they view it as lower risk. So the more risky they view you, the higher the rate, the lower the LTV, and the more points. So I was one of those people that at the beginning I was paying a premium, and then the more confidence I got and the more they saw me paying things down and having the track record, then I saw those terms start to get more in my favor, to the point where now I can basically just dictate the terms that I need. Hey, here's an address. Here's what I'm going to pay for this. And we get that. That's how it works, 500 deals later. So starting out, my recommendation would be partner with someone that has a track record and a relationship. If you can't, just be prepared to pay the piper and make sure that the deal really pencils out, because as you can tell, those points and the interest can get really expensive.
All right. So we'll wrap up about 5 minutes, and then we've got the show dropping at 3 o'clock. But this is a question I'm going to ask you so you respond, Terrance, because we've so Terrance and I mastermind a lot. We talk about our businesses and plans, and this has been, I've seen a very interesting evolution in Terrance as he's gone from single family to multifamily. Just you're scaling like crazy. So Adam Mellon says, are you syndicating deals yet? If not, why haven't you? So, Mr. Doyle.
This question used to come up all the time before this year. Prior to 2020, we did not syndicate any deals. And the biggest reason was speed and simplicity. When you start syndicating deals, it's slow and it takes a ton of legal work and a lot more people involved. And it's like herding cattle. So that's the downside. That's why we didn't do it prior to this year. The reason we started doing it this year was what Chris alluded to, was we had a great business model. We had a lot of success. We owned multifamily. We had done it with our own capital. We had a track record. And the best and fastest way for us to scale was to start aggregating other people's capital, executing the same strategy. So we started to syndicate this year, and it's allowed us to grow. I think we've raised over $10 million of LP capital this year, which has been great. We've been able to do 5 syndications. We've been able to grow our team. That just allows us to execute even better and provide a better return and a safer return to limit the downside to our investors. So it's been a useful tool for us this year. I'm glad I did it the way we did it, which was the first 5 years, we did it with our own capital. We fine-tuned things. We struggled and we failed, like we talked about, really quickly with our own money. And then fast forward to 2020, we felt like we had a pretty good model. We felt like we were in the right market. We had the property management, we had the construction, we had the right people in the right seats, and it made sense for us to raise outside capital. But I would never do it without confidently knowing I've been able to do it with my own capital, and with the understanding that it's going to take a lot of brain damage getting the legal docs, getting all the, everything that's needed, to put together the right marketing material to show people. It's a lot, but it was the right next step, and it was worth the brain damage. And that was the reason, those are kind of the pros and cons. How much allowed to
scale your business, do you think? Because I know that's one of the things we've talked a lot just in our private conversations, like, because you've shared numbers and just how hey, I can do this and just scale this much quicker. Like, can you do a basic quantification of how it's allowed you to scale?
I probably, on my own, I would have been able to do one of the deals. Like, we bought this year with construction $30 to $34 million in real estate this year. And in previous years, we were probably closer to 15. So it's allowed me to double in 1 year, over double in 1 year. So that's been, very useful. And we've been able to do deals, that we normally would not have been able to get into just because of the size.
What about your plans for next year? I mean, you're probably going to double again. I mean, I know you got some big projects on the horizon.
Yeah, we'd like to, we'll probably look to raise 30 to 35 million next year. Yeah. So a little bit more than double. And the simple reason is the projects we bought this year were right down the middle of the fairway. We were able to get some properties well below market value that then got a lot more investor attention. And, just the snowball that we've been able to build has just been able to grow a little bit more exponentially this year. So we'll probably look to capitalize on that, and do some larger deals in Denver and Des Moines. Same strategy, value add, increasing rents, improving property management in markets that we're really familiar with.
All right. Awesome. Well, we are 2 minutes away from 2:30, so we're going to go and wrap this up. I unfortunately had a last-minute change in my schedule, so I have to jet out of here in about 4 minutes. But everyone, thank you. Please, I know we can't answer all the questions. We'd actually love to sit here all day and spend 5 hours answering them. But we got a lot of new ideas coming down for doing more Q&As, more ride-along shows. So please stay tuned. Keep us giving us feedback. Keep asking us questions because we enjoy it. We're going to keep doing it. So, Terrance, thank you.
Yeah, it was a great job, Chris.
Everyone out there, man. Fun. Have a happy and safe Thanksgiving,
happy
guys.
Thanksgiving. Enjoy time with your family. And then, reach out to us on social media. If we didn't get to your question, I've had a lot of people hitting me up on LinkedIn and Instagram, answered as many questions as I can on there. So feel free to reach out and we'll answer some more questions on there.
And also, follow me on Bigger Pockets. I'm not on Instagram, but Bigger Pockets.
Yeah, Chris is much more.
Yeah. That's the one social media platform I use because it's all real estate, none other nonsense.
Fluff.
Yes, exactly. I'm here for real estate. Right. All right, guys, everyone, happy Thanksgiving.
See ya.